real estate's a slow moving animal. And so the trends that we're talking about and the things that we're giving this play by play, but it's not like we're giving the play by play of a 100-mile-an-hour pitch, right? This is happening over quarters, months and months and quarters. And
And you
so,
hear every week, and then they're analyzing a once a month, I guess, piece of data on top of what they're seeing in their day to day, and they do it monthly, at a macro level versus this is a little more nitty gritty and granular.
yeah, so if we take the temperature on the market every week, it's kind of from week to week, there's no real perceptible change. But if you zoom out, the change is absolutely happening. And like in James Eng's monthly webinar, he was talking about supply. We have an oversupply issue in the short term. There's 500,000 to 600,000 units being delivered in 2024. There's going to be a bunch more delivered in 25. So basically, don't count on rent growth for the next year and a half. But
Mm-hmm.
the back end of 2025 and certainly 2026, there's actually going to be a dearth of supply. And that's the nature of a cycle, right? Things don't just move perfectly in a straight line. We kind of overbuild and then we underbuild, overbuild and underbuild, right? Rates go too high, rates go too low. Investor psychology, too greedy, too pessimistic. So it's just one of those cycles. And rent growth is going to come back with a vengeance in 2026. And so if you're looking at your model, like for example, we underwrite as just a standard practice a 3% rent growth per year coupled with 3% expense growth per year. Is that right? No, that's super wrong. Like how in the world could you reasonably actually predict that every single year rents and expenses are just going to go up by 3% perfectly, right? That's obviously not going to happen. That wouldn't be my best guess. But that's what we plug into the spreadsheet as a base case to model our analysis, because it's not really beneficial to us to break it down and think, okay, well, in the first year, it's going to be 1%. Then in the next year, it's going to be 2%. And then the next year, it's going to be 5%. And then it's going to cool down to 3%. No, that's not helpful, because then it makes it difficult to compare apples to apples when evaluating deals.